Before we jump into AI tools, dashboards, and automation, there's something I always like to ground people in first, and that's this. AI does not replace financial system. It sits on top of it, okay? So if you don't understand how financial institutions actually work, who does what and why, AI just becomes a faster way to make the same old mistakes. So today, I want to walk through the financial services landscape using a real-world lens and then layer AI on top of it in a practical way. Not theory, not hype. Now, think of this as the foundation every business owner, student, or future Treasury professional should have before trusting decisions to machines. Okay. Hi, I am 𝗕𝗵𝗱𝗲𝗿𝘀, a finance and fintech consultant. So let's start with how the system was originally designed. All right. So historically, the US government intentionally restricted what financial institutions could do. And the goal wasn't innovation, it was stability. From 1933 to 1999, there were clear legal walls between commercial banking, investment banking, and insurance. Okay, so banks took deposits and made loans. Investment firms handled securities, of course, and insurance companies underwrote risk. Now, this separation lasted for just about 66 years. Not by accident, but by design. And the reason was to prevent too much financial power from concentrating in one place, okay? And this matters for AI because models are trained on behaviors shaped by these rules. See, AI reflects the structure of the system it's analyzing. It does not rewrite it. Now, that structure started changing in a big way around the year 2000. The Gramm-Leach-Bliley Act of 1999 relaxed many of those barriers. And suddenly, banks could offer investment services. Securities firms could behave more like banks. And the consolidation process took off after that. Okay, so suddenly, fewer institutions, bigger balance sheets, and broader product menus, of course, right? But here's the key point. Just because services blended, expertise did not automatically blend with it. Okay? So how does AI plug into this? AI accelerates this trend. Okay? So although the underlying DNA stays the same, AI makes institutions look more capable across board, okay, with what it can do. With that backdrop, let's start with the core institution most businesses deal with. So what are commercial banks and what do they do? See, commercial banks are defined by two things, right? One, they accept deposits. Number two, they make commercial loans. And that's it. That's the core. Okay? And everything else is built around that relationship. So banks range from small community banks to massive global institutions. But the balance sheet logic is the same. Okay? How about AI? See, AI doesn't change what the banks are fundamentally built to do. However, AI helps banks analyze cash flows faster, flag risks earlier, and automate many decisions. Okay. Now, to understand why banks behave the way they do, we have to look at deposits. Now, let's look at deposit accounts and cash behavior. Okay. See, deposits are a bank's liability, not an asset. That's important, right? So, checking accounts, savings accounts, money market deposits, these are short-term by nature, right? You can pull your money tomorrow or anytime that you would like. So banks cannot responsibly lock that cash into long-term loans. And this is why banks specialize in liquidity payments and short-term financing. Okay. How about AI? See, AI models in Treasury often focus on forecasting deposits and outflows because that's the heartbeat of the system. Okay. Now, that short-term nature flows directly into how banks lend. Commercial banks specialize in short-term credit, usually under a year. So, revolving credit lines, seasonal working capital loans, liquidity bridges, right? And these loans are meant to be repaid through inventory turning into sales and receivables turning into cash. Okay. And yes, banks do longer term loans as well, but that's not where they are naturally strongest. How about AI? Although the repayment logic hasn't changed for a number of years, AI helps to improve credit scoring and monitoring. Now, let's talk about where banks overlap with capital markets. Let's talk about investment banks and brokerage firms next. Okay? Investment banks exist to merchandise securities. Their job is origination and distribution. So they buy an issue, they price it, and then they sell it to the market. And they take risk doing it, okay? And this is why the fees exist. Brokerage firms focus on distribution, either execution only or full service advice. AI enhances research and execution. The capital markets still run on confidence and credibility. AI in this case helps with enhancing research and execution. See, not every institution fits neatly into banking and capital markets. There are other institutions which we will review next. Thrift institutions historically focused on housing finance, though their role has declined lately. Credit unions are member-owned and not-for-profit, often offering better rates within limited membership groups. Mutual funds pull investor money and provide diversification, although they're not insured. Okay? Although it doesn't remove market risks, AI improves portfolio analytics. So that is how AI helps in this case with analysis. Now, finally, let's look at the specialists next. So who are non-bank financial institutions, right? See, non-bank institutions fill very specific gaps. Factoring companies, they convert receivables into cash. Captive finance companies, they fund product purchases. Insurance companies, they act as a long-term lender, right? These firms don't take deposits, and that gives them that liberty or flexibility. All right. In this case, AI thrives here because a specialization produces clean data and repeatable patterns. So what does all of this mean in an AI-driven world? Now, here's a takeaway I give clients and students alike. Okay, AI doesn't eliminate financial structure; it exposes it. The better you understand what each institution is built to do, the more value you will get from AI tools layered on top. Okay, so don't ask whether an institution offers a service. Ask whether that service really matches their balance sheet, incentives, and their experience. That mindset, more than any software, is what separates good financial decisions from expensive ones. Okay, and if you are learning this for the first time or rethinking how your business uses financial partners, that's exactly where the real work and real opportunity begins. Thanks for watching.